Your John AG here. If you've been following on Twitter, you already know what just happened. Silver shattered the $90 to $95 support we specifically flagged. And exactly as we outlined, that breakdown opened the door to our next target, 86 dollars. It reached that level, but didn't stop there. As I'm recording this, we're trading around $78. Why the relentless drop? President Trump just nominated Kevin Warsh as the next Fed chairman, not Judy Shelton. Kevin Warsh, a man who publicly calls QE a reverse Robin Hood policy and advocates for rate cuts combined with balance sheet reduction, not unlimited liquidity. This is the precise scenario we warned about in our last breakdown. We said that if Judy Shelton, a sound money advocate, was not the nominee, we could witness prices fall below 86 dollars. And that is exactly what materialized. The market is pricing in a Fed chair who could be hawkish on balance sheet expansion, and silver is reflecting that shift in expectations aggressively. Markets are in absolute panic mode. Gold, silver, and Bitcoin all tumbled. The dollar surged. And here's what you need to comprehend immediately. This isn't random volatility. This is a coordinated policy shift away from unlimited money printing. And the paper markets are pricing that reality for the first time in years. Quick heads up. Your feedback drives this content. Comment below with where you're watching from and your price prediction for next week. I read them all and will cover your questions. Now, before we go further, let me address two different audiences watching this right now. Some of you are long-term physical stackers. You're seeing this dip and you're happy. You're in the comments right now saying you're ready to buy, maybe even sitting back with some popcorn, watching the volatility unfold. Your time frame isn't daily. It's weekly, monthly, even yearly. This price action is just noise to you, a temporary sale on real money. You're accumulating metal regardless of short-term paper games. And this analysis only validates your strategy. Buy the physical, stack on weakness, and ignore the paper price shenanigans. But some of you are short-term traders. You're watching these technical levels because you're in and out of positions. You're managing leverage, stops, entries, exits. For you, the daily price action matters significantly. The technical roadmap I'm providing helps you navigate this volatility without getting wrecked. Both approaches are valid. Know which one you are and trade accordingly. So let's connect the dots from our previous video to what's happening right now. I laid out the exact technical levels with precision. I said the 150-hour EMA would act as support, and initially it did. Price bounced 10% before selling pressure broke that EMA, opening the path to the $90 to $95 support zone I identified. I said if that breaks, $86 or lower is next. It broke. We hit $86 and now we're at $78. The roadmap played out exactly as laid out, and I also discussed the Fed chair announcement in two scenarios. I said if Trump picks Judy Shelton, gold and silver could make the greatest intraday rebound in history because her advocacy for the gold standard would be an existential threat to the paper manipulation machine. But if Trump doesn't pick Judy Shelton and goes with a conventional chair instead, the battle continues, and we hit that $86 or lower level. Well, Trump picked Kevin Warsh, not Judy Shelton. Not conventional in the sense of Powell or Yellen, but definitely not Shelton. The no Shelton scenario played out and we hit $86 exactly, then continued lower to $78. Both the technical breakdown and the policy outcome converged exactly as I laid out. Kevin Warsh is not a new name. He served on the Federal Reserve Board from 2006 to 2011 and played a role during the 2008 crisis. Since leaving the Fed, he has been one of the most vocal critics of how monetary policy was handled after that period. He has repeatedly argued that QE inflated asset prices, increased inequality, and mainly benefited financial markets rather than the real economy. He has described QE as a reverse Robin Hood policy. He has also said the post-2020 inflation surge was a policy mistake, not an unavoidable outcome. Here's the critical part. While Warsh now supports cutting interest rates, his framework is different from what markets are accustomed to. He has advocated for rate cuts combined with balance sheet reduction, not open-ended liquidity. This is a massive issue. Markets are pricing the risk that rates may come down, but liquidity may not expand the way it has in previous cycles. That combination is not friendly for highly leveraged trades, stretched equity valuations, or liquidity-driven rallies. In simple terms, Trump wants lower rates. Warsh wants tighter balance sheet discipline. Markets fear rate cuts without QE. The era of QE is no longer guaranteed, and markets are finally starting to price that reality. Yesterday's sell-off began when the probability of Kevin Warsh becoming the next Fed chair surged sharply. Gold, silver, and Bitcoin tumbled. The dollar jumped. This is a policy-driven move, not a technical breakdown. Now, let's talk about what's happening in the physical market. While paper is getting destroyed, Shanghai spot silver is currently at $122.45 per troy ounce. COMEX is at $78. The Shanghai premium right now sits at over $44 per ounce. That's a 56.83% premium to Western paper prices. Physical silver in Shanghai is trading at nearly 60% above COMEX. Let me say that again, nearly 60% premium. Earlier when we hit $86 on COMEX, the premium was over $30. Now, COMEX has crashed further to $78, but Shanghai is holding at $122. The premium expanded to $44. Why? Because this isn't a momentum trade. It's a war of exhaustion. China doesn't need silver to explode higher. It only needs the spread to stay wide. China doesn't want panic. It doesn't want a reset overnight. It doesn't want headlines screaming system failure. All it needs is a steady 19 to 20% premium over Western paper prices. Following Western price moves doesn't mean weakness. It means control. Physical metal keeps flowing east. Paper keeps fighting itself. Slow pressure beats fast explosions. It's like fishing. You keep reeling in and letting out repeatedly. That's enough to signal real physical stress, drain inventories quietly, force COMEX to hike margins, and let paper markets bleed on their own. And speaking of COMEX margin hikes, breaking news. COMEX just hiked silver margins to approximately $52,000 per contract. That's 10 plurs per ounce just to stay in the game on a 5,000-ounce silver futures contract. What does this mean? More cash required or you're forced out. Leverage gets crushed. Weak hands are liquidated. Paper liquidity dries up. Margin hikes don't happen in calm, healthy markets. They happen when volatility spikes and systemic risk rises. This impacts paper traders, not physical silver. While paper gets tighter, physical silver keeps moving, delivering, and disappearing. Less leverage, less paper games, more stress where it matters. And the physical stress is very real. Another 5.6% out of Shanghai vaults in only one day. The draining continues at a fast pace. Silver closed at $125.40 on the Shanghai Futures Exchange. Gold closed at $5,197. Another 26.94 metric tons of silver removed from SHFE vaults Friday. Total SHFE silver inventories declined to just 455 metric tons. That's 14.6 million ounces. The vaults are getting drained while the paper price is crashing. Connect the dots. Here's the mid-video reveal that reframes everything. While the West is panicking about Kevin Warsh and dumping paper, look at what's happening on the physical side. The Shanghai premium just expanded from $30 at $86 COMEX to $44 at $78 COMEX. COMEX dropped $8 and the premium grew by $14. That's not panic selling in China. That's strategic accumulation. China is letting the West crash the paper price while they quietly buy physical at any price. And it's not just market participants. Governments are waking up to the scarcity. The Czech foreign minister is heading to the U.S. to discuss critical minerals. Silver is not just an investment. Silver is a critical material, and critical materials are discussed when they're becoming scarce, not when they're abundant. When governments start talking about supply chain security, when critical minerals become a matter of national security, it's no longer about charts or paper price. It's about physical availability. Paper can be created endlessly. Physical silver cannot. The Czech foreign minister heading to the U.S. to discuss critical minerals isn't a coincidence, it's a confirmation. Governments are waking up to the fact that China controls the physical supply while the West plays paper games. We called $86 or lower if Trump didn't pick Judy Shelton, he didn't. We hit $86, then $78. And while paper crashes, the physical market is tightening into a national security issue. That's the disconnect stackers understand. Stackers aren't paranoid. They're early. And what China is doing is brilliant. They don't need explosive moves. They don't need headlines. They just need a consistent 19 to 20% premium that quietly drains Western vaults, forces COMEX margin hikes that kill paper liquidity, and positions them as the physical price setter when the paper market finally loses credibility. That's the war of exhaustion. That's the long game. And here's the kicker. PPI inflation just came in hotter than expected. December PPI inflation at 3% versus expectations of 2.7%. Core PPI inflation unexpectedly rose to 3.3% versus expectations of 2.9%. Core PPI inflation is now at its highest level since July 2025. PPI inflation is running hotter than expected. And what happened? Silver got dumped. Gold got dumped. The inflation hedge assets got sold off on news of higher inflation. Does that make sense? No, it doesn't. Unless you understand that these are rigged, contrived, fraudulent markets where price is set rather than discovered. Over the decades, the LBMA and COMEX have proven that they are incapable of running a free and fair market. The past 24 hours are merely a continuation of those practices, but it's worse than shenanigans with precious metals. The same games have led to copper being badly underpriced, and we're due for a mega shortage there too. Stocks are also heavily manipulated. Prices are set rather than discovered. But what if this is intentional? What if the plan all along has been to wreck the smaller PM dealers by throwing unserviceable volatility at them? What if the plan is to set the larger financial markets up for the sort of failure that triggers consolidation of everything into the hands of the few? You'll own nothing and be happy. Did you ever wonder exactly how that was going to come about? Well, you are witnessing it unfold in real time in these entirely fake, contrived, rigged markets. Now let's address the bearish case because we hit $86 or lower like I predicted, and now we're at $78. The technical damage is real. We broke the $90 to $95 support. We hit the $86 or lower level I identified, and the selling continued, taking us down to $78. If this pressure continues, we could see further downside. The momentum is bearish. The Fed chair pick was not Judy Shelton, the gold standard advocate we hoped for. Trump went with Kevin Warsh instead. Warsh is anti-QE. Markets are pricing tighter liquidity even if rates come down. That's bearish for highly leveraged assets. PPI inflation coming in hot doesn't matter if the Fed is going to tighten the balance sheet. Inflation running hotter than expected should be bullish for gold and silver. But if liquidity is contracting, short-term price action can remain bearish. The paper market can stay irrational and suppress longer than most traders can stay solvent. If you're over-leveraged, if you're trading on margin, this environment will destroy you. The COMEX margin hikes are designed to flush out weak hands. They're working. And here's the other risk. If Kevin Warsh actually follows through on balance sheet reduction while cutting rates, we could see a prolonged period of tight liquidity that keeps pressure on all assets, including precious metals. The era of QE might really be over. That would be a fundamental regime change. Markets haven't priced a world without QE in over 15 years. The adjustment could be brutal and prolonged. But here's why the bearish case for paper doesn't change the bullish case for physical. Reality is coming at us fast, and real things now have options. China has become the place where true silver physical price discovery is being set, and that means the entirely fraudulent US London paper markets are becoming irrelevant quickly. The massive gap between the paper price in New York and the physical price in China tells all. Such a thing cannot persist in a real market. We're in the death throes phase of a wildly mismanaged debt-based fiat money regime. The Czech Republic is flying ministers to the US to discuss critical mineral supply chains. That's not speculation. That's governments acknowledging physical scarcity. Shanghai vaults drained 5.6% in one day. 14.6 million ounces left in SHFE inventories. COMEX hiked margins to $52,000 per contract. These are signs of physical stress, not paper weakness. China's strategy is working. Steady 19 to 20% premium, quiet accumulation, forced margin hikes that kill Western paper liquidity. And when the paper market finally breaks, when the spread becomes so wide that arbitrage forces physical delivery at scale, China will be the dominant physical holder and price setter. That's the end game. That's what stackers understand that traders miss. So, where does this leave us? 3 key takeaways, and we're out. Number 1, I laid out the exact technical levels in our previous video, and they played out perfectly. The 150-hour EMA held initially with a 10% bounce, then broke under selling pressure, taking us to the $90 to $95 support zone. That broke, taking us to exactly $86 just like I said. And then the selling continued, pushing us down to $78 as I'm recording this. The technical roadmap I provided proved accurate. If you're a short-term trader, these levels help you navigate volatility. If you're a long-term stacker, this dip is a buying opportunity. Know what you are. Number 2. Kevin Warsh's Fed chair, not Judy Shelton, means the battle continues, but the regime is shifting. Warsh wants rate cuts with balance sheet reduction, not open-ended QE. Markets are pricing the end of the liquidity era. That's bearish for paper in the short term, but it validates the long-term thesis for sound money and hard assets. If QE really is over, fiat debasement slows, but trust in paper continues eroding. Physical wins either way. Number 3. China's war of exhaustion is working. Shanghai premium now at over 56%, $44 per ounce. Vaults draining 5.6% in one day. COMEX forced to hike margins to $52,000 per contract. Czech ministers flying to discuss critical mineral supply chains. This isn't about daily price. This is about physical availability becoming a national security issue. Paper can be printed. Physical cannot. China understands this. Stackers understand this. The paper traders are about to learn it the hard way. The unresolved tension is this. We hit $86 like predicted, then dropped to $78. Does this level hold, or do we see one more flush lower before the physical reality overwhelms the paper manipulation? And as China continues draining vaults at nearly 6% per day with the premium now at 56%, how long before Western inventories hit critical levels and force a pricing regime change? I called 86 guys a sister lower if Trump doesn't pick Judy Shelton and goes with a conventional chair instead. And we hit that $86 level. Now we're at $78, and the premium has exploded to 56%. The technical levels are playing out. The physical fundamentals are screaming scarcity. The policy regime is shifting away from unlimited QE. And China is quietly winning the war of exhaustion, while the West fights over paper prices. This is the disconnect. This is the opportunity. This is the moment where you decide if you're stacking physical reality or trading paper fiction. Do your own due diligence. Understand the risks. If you're trading on leverage, this volatility is a meat grinder. If you're stacking physical with a long-term view, this is exactly the kind of shakeout that creates generational buying opportunities. Time will tell who understood the game. Invest with logic, not hype. OG out.